Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results.
So stressful when the world's on fire. Good God. I can't look at this, guys. Like, my strategy is you buy it and you hope that you got a good spot. Yeah, but we all think you're crazy. You don't fight this. No way. The markets are freaking out and you don't think that anything is wrong? Come back tomorrow and I'll lose it all. Should be fun.
Good morning, everybody. It is Thursday. I'm feeling a little bit better today. Start that music. Let's come over to the charts and review what happened. So we had a Federal Reserve meeting yesterday and the Treasuries took a huge leap up, huge amount of easing in here. Interest rates down below 3.4% in dimes, and we've got another move developing already here on the way up. And normally one might think, oh yeah, we had a big day, we should have a pullback today, and I would not necessarily be trying to play that today, especially not in the Treasuries, because there are a lot of shorts that probably have to cover. So this could get a little bit zany. Here's the S&P 500. After market, this spike right here, after market, Facebook earnings really good. Their stock is up 20%, and that is a huge factor this morning. Moving on to other assets, oil is actually still down. Natural gas very, very low. Gold and silver really took off after that Federal Reserve meeting. And Kappa is still kind of down. Right, so I believe that gold and silver are moving just because the rates are lower, and that's really been keeping gold back. Oh wait, sorry, we should check the dollar too. So here's Bitcoin had a big jump off of the news as well. The dollar taking a plunge and now down below 101. So that's helping gold out. So I think that's how we should read that one. But in terms of the like the overall economy, that copper, for instance, and oil are not moving with them is kind of not necessarily a good thing, right? It still kind of suggests to me that investors think that some sort of a stagflationary environment is on the horizon. I do not believe fundamentally that this low of an interest rate is sustainable for very long, because you can just see it over in the S&P 500. They're just going absolutely bonkers. So if you ease off of the gas pedal at all, it seems like all of the money floods back into the market, and that's going to cause inflation right away. And so one of the things that Powell said was, historically, we have a problem with the inflation coming back, right? And I think that they are very right to be cautious and aware of that. And so even though right now they're speaking very, very dovishly, it seems to me like there's been a little bit of a shift in the market where it's kind of been like, it used to be you really want to keep the market on its toes so that you can try and shock them. I think now what you're doing is speak softly and carry a big stick, right? Like everything that the Federal Reserve members have been saying and everything that Jerome Powell did in his press conference appears designed to try and keep the market at ease, but then they keep the interest rate increases up. And that could lead to a situation later on down the line where the market gets really upset, right? They've all positioned themselves for dovishness, and then, you get another rate hike in May or June, and they just keep going, right? Another thing from a fundamental perspective is, we talked about this a lot earlier. There is this question about what actually creates tight financial conditions. So, well, sorry, let's okay, make sure that the music keeps going. One position is that in order to create tighter financial conditions, you need to get interest rates up above a certain level, right? And typically that would be, you want interest rates higher than the level of inflation, right? So that at least people will want to continue buying your bonds is what that comes down to. Okay. But the other side of it is that increasing rates and the pace of the increase in rates creates tight financial conditions. Based on our knowledge of the markets and order flow, we would tend to be on the other side of that argument, tend to be on the side that says that it's the actual, like, as you raise interest rates and that forces flows to come in and sell bonds, and so that creates tighter financial conditions, right? And so I am concerned here as well that because of the approach that the Federal Reserve is doing here, that the looser financial conditions that we're getting at the moment are going to be a problem in the long run. So again, I'm worried that inflation is going to come back, is the main gist of it. But that doesn't really matter today. Today, the flows are all long, and there are some people that desperately want out of these treasuries here. So look at the way that it's moving. We have important news coming up here in 30 seconds. We have U.S. initial jobless claims coming out. Previous reading 186, estimate 195. So let's say that one comes out 175 or something like that. That could hurt the treasuries, right? But I'm gonna bet that you're gonna continue to see people puke anyways. So let's see how this goes. There's the polling. Okay, so it is a little bit lower than expected. It's 183 versus 195. And you can see some selling. Oh, by the way, GFD, welcome to Deluxe. Thank you very much. We appreciate the support. Yeah, look at this. U.S. unit labor cost preliminary 1.1 versus 1.5. Productivity preliminary 3% versus 2.4. So I don't see any of those numbers that are like explicitly dovish. Or is a downward revision to a previous initial jobless claims reading as well. Oh, what's this? Nomura. Chair Powell opened the door for potential rate cuts later this year. Until today's FOMC meeting, most FOMC participants stressed a no rate cuts this year message. However, at the press conference, Chair Powell highlighted the data dependency of their decision making on rate cuts. And he said, if we do see inflation coming down much more quickly, that will play into our policy setting. Of course, while he maintained his base case of no rate cuts this year, he acknowledged the possibility of potential rate cuts, which is important in our view. We believe core PCE services shelter inflation will be critical for the decision of whether to cut rates in the second half of 2023. In terms of the risk inflation rebounding, we see relatively persistent core PCE services ex-shelter inflation as a component with substantial rebound risk that will be at the top of mind for the FOMC. Because this subset of inflation is heavily driven by wage inflation, Powell highlighted the importance of upcoming ECI prints and labor market strength more broadly, frequently in his comments. Hence, we believe easing labor conditions and falling wage inflation are key for this segment of core PCE inflation to reduce enough to motivate the September 2023 rate cut that we expect. Okay, so a bit of interesting volume there. I'm still getting pretty crappy spreads and everything in the micros. We can play over here a little bit. Some sim orders. Doing some sim orders is a good way to try and get yourself back in the groove of things. I need to trade sim more often. When I don't think that there's a good trade. I was really thinking about taking 335, but I didn't like the spread. 10-year treasury yield dips 4 basis points after jobless claims fall. Yeah. See, that one doesn't make sense. So if you're basing things just off of the jobless claims falling, why would that be lower rates, right? Oh, this is the 30-year kind of took a jump up there. You gotta be careful here though, because the liquidity already looks a little sketch. See, in this sim trade, if I'm using multiple contracts and I can kind of build myself a buffer, then I can probably work it out and it's probably okay. But here in the micros, I really need to get a good price first. Oh, that's right. We get ECB press conference today. How? So I had not thought about that one yet. How does that change things for us? Lagarde could be hawkish. I don't know. This is where I wish I had a better, tabs on what was going on at the ECB. Okay, this is good fill there. There was a pull at 24.5 there. Wow, that was good. That set of fills that I got there was really good. I can't believe that I got my break even all the way down to 22. Dollars just whipping all around here too. I guess I can do another one at my cost basis if they're so kind. I'm looking over here at the micros though. I really don't think I can justify a sell below 3.35. But I don't think that I'm ever, if I get filled at 3.35, it's probably going to go quite a bit higher than that. Morning, Ismail. You had an idea you want to try? Okay. No fill, but I got a good spot in line at 24. So if that fills, that might actually be really good. Let's see here. I actually didn't like how that happened. Because it filled me, but it was because the bids pulled. And it was a decent offer was stacked on it when it went to. Now I want to try Sierra Charts and just trade via my broker because Sierra Charts doesn't support it, and then later move on to something similar to your workflow because it's more expensive starts. So I think that starting small and you know growing as you get things working is a good approach. So Sierra Charts is like so the nicer version is like $30 a month or something like that, right? So there are other options that are even cheaper, but because there are some options like for instance Quant Tower. You can often get Quant Tower for free from your broker, right? So, or like another one is Iron Beam, right? Iron Beam has a pretty decent platform. I wouldn't say that it's like super customizable or anything, but they have a pretty decent platform. In fact, as you know, I made a sponsored video with them that's like my beginner video, and I really pushed to have their product or my beginner video because I felt that it was the easiest way to get started in futures. So yeah, ATAS is a little bit more expensive, isn't it? Well, I mean, not a little bit more expensive. I think that it's typical in terms of like how much you pay per month. But I guess what I'm saying is that the specific platform that you're using, in terms of like the effect that it's going to have on your performance is often actually quite minimal, right? So that's why, for instance, I'm always going on to like with NinjaTrader, the big advantage of NinjaTrader is their ecosystem is so huge. and their community and the number of users and available things you've got there is so huge, right? So that kind of implies that as long as your platform isn't crashing and is executing correctly, and you can see the actual orders, you know, beyond that, it doesn't necessarily matter what you get. You know what I mean? Yeah, and you just get your foot in the door and see how it goes. Because it's a hard thing. It's a futures trading is not suitable for all investors, right? So it's true. One of the mistakes that I think I see a lot of people do is like they say, "Oh, I want to go into futures trading," and you know, they want it to be like their primary source of income someday, and so they're like, "Well, I'm going to have to invest a lot into it," and they dump like 20K into it and blow it all, right? Yeah, absolutely. It's better to start small. Well, I'm not sure about that one. So they've kind of been coming around here. It looks like the sellers are going to pressure this downside here. Time for me to pull up the ECB here. European Central Bank. Like, look, we're at the lows now. Well, this is actually good because I only have one contract on. So if I wanted to continue taking on risk, I could see if I get filled to 21.5, but I don't like it being right there at the lows. I'd prefer it to be a little bit below the lows because, you know, if a large meta order really comes through here, they're going to go a lot further than that, right? And with the ECB on deck, it's probably not the best time for me to be taking on additional risk. Probably don't trade UK bonds, but what do you think of the interest rate release from the Fed in the UK? Yeah, well, so there was not too much surprising in the meeting, other than that the journalists gave Powell every opportunity to smack the market down, and he just wouldn't take the bait. So I think that was a little bit of a change from him, although it's still in line with the larger kind of thing that I've been seeing from Powell, which is that he really just does his darndest to try and not actually say anything significant, you know. Now, the UK, they increased rates 50 basis points. And, you know, the situation in the UK, the economic situation in the UK doesn't look very good right now. So we'll see where that goes. Okay, so now we're getting the ECB. All of the press people are able to come out and take pictures of her now. I'm still getting their music, so we'll wait. I guess I'll pause my music here. I mean, I might have been able to pull one out at 22, but I think I would say the most important thing is you need to be able to see the market orders and make a determination about, is there an imbalance between the market orders? And if you can do that on a bunch of assets next to each other, that's even better. Easiest way to do that is with a DOM. Good DOM that has current trades column in the middle, and CR Charts definitely has that. Okay, here we go.
ECB's Lagarde is now at the stand.
Welcome to the ECB press conference.
So ECB's Lagarde is now at the stand.
By President Lagarde and by Vice President de Guindos. My name is Wolfgang Preußel. We are in a hybrid format again, so I would like to ask our colleagues, the journalists who are joining via WebEx, to turn on their cameras and their microphones when they ask questions. And now over to President Lagarde, please.
No film.
Thank you very much, Wolfgang, and good afternoon to all of you, or good morning for those who are overseas. The Vice President and I welcome you all to the press conference, and we would like to begin this press conference by congratulating Croatia on joining the euro area on January 1st, 2023. We also warmly welcome Boris Vucic, the governor of Hrvatska Narodna Banka, the National Central Bank of Croatia. We will now report on the outcome of today's meeting.
Carl Quintillo says if initial jobless claims fall just another 16K, you'd be taking the lowest since 1967. What?
At a steady pace, and in keeping them at levels that are sufficiently restrictive to ensure a timely return of inflation to our 2% medium-term target.
Came back up there awfully quick.
The Governing Council today decided to raise the three key ECB interest rates by 50 basis points, and we expect to raise them further. In view of the underlying inflation pressures, we intend to raise interest rates by another 50 basis points at our next monetary policy meeting, and we will then evaluate the subsequent path of our monetary policy. Keeping interest rates at restrictive levels will over time reduce inflation by dampening demand, and will also guard against the risk of a persistent upward shift in inflation expectations. In any event, our future policy rate decisions will continue to be data dependent and follow meeting by meetings approach.
Well, so far the order flow that I'm seeing in dimes has completely disconnected from Lagarde.
Modalities for reducing the Eurosystem's holdings of securities under the asset purchase program. As communicated in December, the asset purchase program portfolio will decline by 15 billion euros per month on average from the beginning of March until the end of June 23. And the subsequent pace of portfolio reduction will be determined over time. Partial reinvestments will be conducted broadly in line with...
Cancel that even though I get a good spot.
In particular, the remaining reinvestment amounts will be allocated proportionally to the share of redemptions across each constituent program of the APP and under the public sector purchase program to the share of redemptions of each jurisdiction and across national and supranational.
Somebody bought at 335 there.
Corporate bond purchases, the remaining reinvestments will be tilted more strongly towards issuers with a better climate performance. Without prejudice to our price stability objective, this approach will support the gradual decarbonization of the Eurosystem's corporate bond holdings. No,
it's often that the market doesn't really care as much about the ECB, but you can often get like really choppy and directionless action until they're done. So we might as well just watch it.
The detailed modalities for reducing the APP holdings are described in a separate press release, which will be published at 3:45 local time. I will now outline in more details how we see the economy and inflation developing, and will then explain our assessment of financial and monetary conditions. So looking at the economic activity first. According to Eurostat's preliminary...
I'm not entirely sure what gold is doing at the moment. It may just be a pullback. They had a really good run yesterday.
0.1% in the fourth quarter of 2022. While above the December Eurosystem staff projections, this outcome means that economic activity has slowed markedly since mid-22, and we expect it to stay...
They're running there.
Subdued global activity and high
So they had a liquidity hole here in the 25 area, and now they're coming up to the top end of it, and there doesn't appear to be very much resistance.
continue to act as headwinds to euro area growth. Together with high inflation and tighter financing conditions, these headwinds dampen spending and production, especially in the manufacturing sector. However, supply bottlenecks are gradually easing. The supply of gas has become more secure. Firms are still working off large order backlogs, and confidence is improving. Moreover, output in the services sector has been holding up, supported by continuing reopening effects and stronger demand for leisure activities. Rising wages and the recent decline in energy price inflation are also set to ease the loss of purchasing power that many people have experienced owing to high inflation. This, in turn, will support consumption. Overall, the economy has proved more resilient than expected and should recover over the coming quarters. The unemployment rate remained at its historical low of 6.6% in December 2022. However, the rate at which jobs are being created may slow, and unemployment could rise over the coming quarters. Government support measures to shield the economy from the impact of high energy prices should be temporary, targeted, and tailored to preserving incentives to consume less energy. In particular, as the energy crisis becomes less acute, it is important to now start rolling these measures back promptly in line with the fall in energy prices and in a concerted manner. Any such measures falling short of these principles are likely to drive up medium-term inflationary pressures, which would call for a stronger monetary policy response. Moreover, in line with the EU's economic governance framework, fiscal policies should be oriented towards making our economy more productive and gradually bringing down high public debt. Policies to enhance the euro area's supply capacity, especially in the energy sector, can help reduce price pressures in the medium term. To that end, governments should swiftly implement their investment and structural reform plans under the Next Generation EU.
Wow.
The reform of the EU's economic governance framework should be concluded rapidly.
Well, I tried.
Turning now to inflation. According to preliminary Eurostat's flash estimate, which has been calculated using Eurostat estimates for Germany, inflation was 8.5% in January. This would be 0.7 percentage point lower than the December figure.
So I'm feeling the emotions that upset me.
Renewed sharp drop in energy prices. Market-based indicators suggest that energy prices over the coming years will be significantly lower than expected at the time of our last meeting. Food price inflation edged higher to 14.1%, as the past surge in the cost of energy and of other inputs for food production
The S&P
is
500.
still feeding through to consumer
Are
prices.
they going to touch 4,200 today? That would be a little. That would be a little crazy.
Remain strong, partly because high energy costs are spreading throughout the economy. Inflation, excluding energy and food, remained at 5.2% in January, with inflation for non-energy industrial goods rising to 6.9%.
So if you look at a daily chart of the S&P 500,
4.2%.
once we get over 4,200,
Other indicators of underlying
that's when you're like in clearly
government measures
territory where chart analysts would clearly say we're in an uptrend.
will dampen inflation in 23, but are expected to raise inflation once they expire. At the same time, the
Like over 42, a strong close and follow through above 4,200 would cause chart analysts to say that the downturn is over, that the bear market is over.
Although supply bottlenecks are gradually easing, their delayed effects are still pushing up goods price inflation. And the same holds true for the lifting of pandemic-related restrictions. While weakening, the effect of pent-up demands is still driving up prices, especially in the services sector. Wages. Wages are growing faster, supported by robust labor markets, with some catch-up to high inflation becoming the main theme in wage negotiations. At the same time, recent data on wage dynamics have been in line with the December Eurosystem staff projections. Most measures of longer-term inflation.
So I want to be short in the micros,
stand at
but
around
I'm actually kind of looking at this spot and thinking it might be time to get out on my sim in the full in dimes. So why would I want to be entering a position down in here, right?
The risks to the outlook for economic growth have become more balanced. Russia's unjustified war against Ukraine and its people continues to be a significant downside risk to the economy and could again push up the costs of energy and food. There could also be an additional drag on euro area growth if the world economy weakened more sharply than we expect. Moreover, the recovery would face obstacles if the pandemic...
Yeah, the dollar is moving up big time.
...and cause renewed supply disruptions. However, the energy shock could fade away faster than anticipated, and euro area companies could adapt more quickly to the challenging international environment.
It kind of seems like the markets are saying that they expect the euro area to be weaker now.
The risks to the inflation outlook have also become more balanced, especially in the near term. On the upside, existing pipeline pressures could still send retail prices higher in the near term. In addition, a stronger than expected economic rebound in China could give a fresh boost to commodity prices and foreign demand. Domestic factors such as a persistent rise in inflation expectations above our target or higher than anticipated wage rises could drive inflation higher also over the medium term. On the downside, the recent fall in energy prices, if it persists, may slow inflation more rapidly than expected.
Okay, 30 is the spot.
In the energy component could then also translate...
Was a little early, but I think 30 is the spot.
Inflation. A further weakening of demand would also contribute to lower price pressures than currently anticipated, especially over the medium term. So let's now look at the financial and monetary conditions. As we tighten monetary policy,
we might see some extension here, though.
Interest rates are rising further, and credit to the private sector is becoming more expansive. Bank lending to firms has decelerated sharply over recent months. This partly stems from lower financing needs for inventories, but it also reflects weakening demand for loans to finance business investment in the context of a steep upward move in bank lending rates and a considerable tightening in credit standards, which is also visible.
So that would have been my trade. Take $20. Yeah.
Survey. Household borrowing has continued to weaken as well, reflecting rising lending rates, tighter credit standards, and a sharp fall in the demand for mortgages. As loan creation decelerates, money growth is also slowing rapidly, with a marked decline in its most liquid components, including overnight deposits only partially compensated by a shift to term deposits.
Remember Trump? What about him?
So summing up, the Governing Council will stay the course.
And 116
in
even,
raising
it was
interest
just
rates
like a skip away.
significantly, at a steady pace, and in keeping them at levels that are sufficiently restrictive to ensure a timely return of inflation to our 2% medium-term target. Accordingly, we today decided to raise the 3 key ECB interest rates by 50 basis points, and we expect to raise them further. In view of the
She's been talking a long time
we intend to raise interest
before even getting to the questions. It's unusually long
next monetary policy
opening comments, isn't it?
and we will then evaluate
He used to say illegal immigration will destroy the economy.
our monetary policy.
It was a little bit
Keeping
more
interest
nuanced than
rates
that.
at restrictive levels will over time reduce
Saw a
inflation
big sell in
by
ZT.
dampening demand and will also guard against the risk of persistent upward shift in inflation expectations. Moreover, from the beginning of March 2023,
We're seeing some more flatteners.
portfolio will decline at a measured and predictable pace, as the Eurosystem will not reinvest all of the principal
There's
payments
116.
from maturing securities. Our future policy rate decisions will continue to be data dependent and determined meeting by meetings. We stand ready to adjust all of our instruments within our mandate to ensure that inflation returns to our medium-term target. And we are now ready to take your questions.
We need to be careful here in the treasuries because we've had 3 legs of this upside.
Rando of Bloomberg News.
Stream is dead. No, we're still good.
Jana Rando with Bloomberg. Good afternoon.
Good afternoon.
We've already had 3 legs, so for this to continue from here, that would be like
Can you tell us a little bit about the flavor of the debate that
truly
preceded
large
today's
move.
decision to raise interest rates by 50 basis points in March? I'm interested in knowing whether there were any calls to commit for longer, potentially flag a less aggressive stance, or say nothing at all, given that you also say that your decisions are data dependent. That would be my
Sure does seem like there's a divergence between the approach at the ECB and the Federal Reserve, doesn't there?
Say the subsequent policy path will be decided in March. Are we just talking about the pace of rate increases, or could one potential conclusion also be that you have already reached the peak in interest rates at that time? Thank you.
Thank you very much. Those are really good questions to try to explain our decision. And I would just remind you that our decision is not the decision for March. We're taking a decision as of now, which is to raise all 3 interest rates by 50 basis points.
It seems to me like I could add another record stream,
good discussion.
but having the 2 that I had would not be.
Given that we are now 26 around the table, I would characterize them as marked by the sign of continuity and consistency.
But
And I know
my
that I
things
have
are all
repeated
still
that in
updating,
the
so I think
course
we're
of
okay.
the monetary policy statement, and I have said it before, but the expression "we shall stay the course" or "the governing council will stay the course"
Dollar's coming back there hard now.
express that double principle of continuity and consistency. Continuity because we were very clear in December that in all reasonable scenarios, significant rate increases would be needed. Would be needed for what? To bring inflation up to the 2% medium-term objective that we have in a timely manner. And we also
What was
made clear
that?
this would require rates to rise to sufficiently restrictive levels, and that rate increases would happen at a steady state. So we are really
Lagarde, in all reasonable scenarios, significant hikes are
in
needed.
that continuity that I have tried to explain. Steady state, we increased rate by 50% in December.
Don't you think trading significant news is more difficult? Well, the really, really big ones, yes, yes.
Early February, and we intend which is a strong word. It's not an absolute, irrevocable, and conditional commitment, but it's a strong
I'm
word.
not sure if the
intend to raise
treasuries are
by 50 basis
reacting to what
points.
Lagarde is saying there or not.
In December, by this steady state reference that you find yet again in the monetary policy statement.
I mean, it seems like she's talking hawkish, and then I was seeing all this buying here. Well, look at that. That fell back real
Where we
fast.
have consistency,
Some absorption at 29,
consistency
which makes
with the
sense.
communication that we had back in December and with any communication that I have expressed ever since. And it's totally consistent with the view that we reached in a very, very large consensus today, that it should be 50 this time around. It is intended to be 50 in March. Now you will say, well, yes, but what about after March? Does that mean that you have reached the pinnacle or the peak? No. No, no, no.
See, this is what I thought Powell was going to say yesterday.
We are not done. What we are saying is that as we will receive projections, we will need to assess what rates, what level, at what pace.
Well, just note that pullback just comes back to where I had gotten out at, so.
Which in my view are embedded in my expression, stay the course. The first one is to raise.
I don't think she's saying the worst is still yet to come, but I think she's just saying that we're not anywhere close to done.
Stay there for sufficiently long so that we are confident that at those rates we will actually deliver the 2% objective medium term that we have set for ourselves and which is delivering on our...
Nah, I'm just saying we did have a burst of volume up there at the top, and I'm not entirely sure what the cause of that volume was. You would think that it was a reaction to something Lagarde said, but I don't quite understand why what she was saying might have driven that kind of volume.
Particularly in March, of the underlying inflation pressure that we know will continue. I think where there was discussion and not full agreement was on the way in which we communicate it. But on the overall monetary policy statement that reflects our discussion.
There's definitely a sell coming through here now, though.
Consensus. So I hope I have addressed your two important questions.
Thank you, President. The second question goes to Balázs Korani of Reuters. Balázs, please.
Good afternoon, Balázs Korani from Reuters. Thanks for taking my questions. President Lagarde, back in Davos, you said doubters should revise their positions if they don't believe that you're serious about inflation. But markets are again doubting you because the reaction to this decision was for financial conditions to actually ease a bit and expectations to come down. So what would you say to doubters today? And when you just told Jana that you have ground to cover, we are not done, are we correct to interpret that more rate hikes are coming beyond March at an unspecified rate? Is that what you meant? The second question is about the signals that you're sending. I mean, gas prices have come down to pre-war
That's why she's looking over to the side.
Since the summer. Your lending data is showing the biggest liquidity lending crunch since the debt crisis. Growth is at a standstill. There are lots of deflationary or
Is growth at a standstill, though?
in the economy. So
I don't know, man.
would you set a guidance without having seen your projections? And why would you keep on providing a guidance when you said you would stop doing it? So I'm trying to understand the logic of how you communicate and why it's meeting by meeting one day and then you provide a guidance the next. Sometimes it's difficult to read what the ECB intends according to the people that we speak to.
Which is why I'm trying to, explain a bit better our reaction function. And I've tried to do that with Jana, if I may call you so, given that you do. But I will happily try to re-explain a bit what our intention is. First of all, we are data dependent, and we know that we're getting a projection exercise at our next March meeting. But we are also data dependent when we look at underlying inflation elements, and the underlying inflation pressure seems to be, whether you look at core, trimmed, super core, in all sorts of dimension, adding to which the measurement of the fiscal measures that have been put together, the wage negotiations and the wage direction that we are seeing. We have all scenarios available to decide that March actually warrants a 50 basis points.
I'm still feeling a little emotional, like I want to do something, but when I look at it, I'm not sure what, because that very well could have been the high.
We shouldn't be doubted, and I think it was very much in relation to what we were going to do this time around and what we were going to do in the following meeting. And I hope that by being very specific about today's decision and pretty strong in terms of intention as to what we will do in March, those who observe carefully what we do will appreciate that we should not be doubted. And our determination to reach 2% medium-term inflation should not be doubted. And our determination to raise rates sufficiently significantly.
I tell you what, nothing would make me doubt you more than you telling me that I shouldn't be doubted.
Nor should be doubted the fact that once we
Did I say that correct? Nothing's going to make me doubt you more than you saying that you shouldn't be doubted.
And be confident that those rates will give us the return to the 2% medium-term inflation objective that we have. Now, you will say, is that consistent with the meeting-by-meeting approach? You know, let's call a spade a spade. Meeting by meeting is going to be applied on the basis of data. But when we have data that is sufficiently strong, and when we are sufficiently far away from what we expect will be the appropriate rate to reach the 2%, it is completely legitimate to express an intention in a relatively forceful way. An intention is not, as I said, 100% commitment, but it's a pretty strong determination. And I can't, think of scenarios, unless they were quite extreme, where that would not happen.
Thank you.
You're a very experienced sim trader. I am. I am.
President Lagarde, thank you very much for taking my question. I have one question on whether you're also discussing the negative side effects.
It's gonna come all the way back, huh?
Now policy raising rates substantially.
Maybe it's just all over.
Especially on sectors like the real estate sector.
I mean, you were here yesterday. You saw me lose the money, right? So it's not always sim.
Going forward. And then my second question goes on to QT, quantitative tightening. Perhaps you can explain a little bit more what you think you want to achieve with it, and
it's not the same as life.
Discussion to accelerate it and use it as an efficient policy tool. Thank you very much. Yeah.
I take on way more risk on sim.
The occasion of this meeting was a very appropriate way to try to measure the effects and the consequences of our most recent monetary policy decisions. And it was so because we had the bank lending survey, which really helps appreciate how banks themselves see the rates that they will be offering, depending on whether they offer financing to corporates or to households or
sim is better.
Consumption purposes. And it's also a good opportunity to have them assess for...
I'm trying to be serious here, NASDAQ.
Whether they are going to tighten terms and conditions or not. Final point that we draw from those bank lending surveys that I'm sure you had a chance to look at as well is how they see the risk assessment proceed and develop as the situation evolves. And I would say that all that we are seeing, which is a tightening of the financing terms and conditions, higher rates across the various sectors of lending, is...
The thing is on sim, I will pick up positions that if there was a big piece of news that pushed against me, I'd be finished. But like, since that rarely ever happens, I always get away with it.
Is more expensive. Impacts will channel through into the real economy, but we can tell that there is transmission of those rates already, and that was part of the propositions that we had. Obviously, we are hearing the banks, and we have good dialogues with the banks on impacts that all our measures have.
So are we getting some steepening now?
Interest rates as well, in a different direction. So
it is interesting that we saw that selling in the 2-year that Octavius warned us about, and then there was a little bit further of a push up, and then it turned around almost after that.
That we follow, but our objective is
just need a side hustle. I wonder how much those journalists trade.
To drive it down to 2% in the medium term. So there will be consequences.
So if I was a journalist, I wouldn't trade on something like news that I haven't released yet. That would be unethical. But I would certainly feel like I might know certain situations better, and all of this information is public and trade it. Yeah.
Very fast start with the fact that in the current circumstances, our main tool is, of course, the interest rates. And the balance sheet normalization is helping us normalize.
So on this move, there is some reasonable amount of volume on the selling, but it also looks to me like that this move up happened so fast that there's not a whole lot of resting liquidity. So it was able to retrace it very easily. But that just kind of puts us back into the hole that we were at before. I don't know if they build a base and they try and go higher again, or what they do from here.
Predictable and measured.
It might be difficult because they might just form a trough here again.
From March to the end of June, that's what we're doing. So yet again, continuity, consistency.
I'm mad because I missed the trade. I wanted to be short 3.35. And I put an order out and everything, but I didn't get filled. I don't know how I would have managed the getting out part, but that probably would have been enough for me today.
Principle to the portfolio across jurisdictions. Thank you.
Thank you, President. And the next question goes to Aude Kurselek of the French television channel BFM Business.
Good afternoon, Madame Lagarde, and thank you for taking my questions.
Our favorite reporter.
First one, could you say it was a compromise between governors to nearly decide of 3 hikes of 50 BPs in a row from December to March? Does regularity matter to you? And does that mean it could continue at this pace in May? And a second question, in many sectors, companies and institutions as well, employees are asking for salary increases. What's your message about that? And at what point do these increases become dangerous with the risk of entrenching inflation? Thank you.
Well, thank you for your question. Any decision is the fruit of a compromise. And
she asked a good question. I'm telling you, that girl is smart, man.
Passionate.
Maybe I just have a crush on her, but she talks smart. She asks smart questions. She looks smart. I really like that reporter.
And, some take particular views, others other views.
She quit their jobs and buy my course.
Meetings.
No, the reporter.
And by the work that they have done within the Eurosystem, but
I forget what her name is now.
And the beauty of the exercise for me is to see how they can coalesce towards solutions that are recommended by our chief economist, Philip Lane, that I fully support, and that inevitably have elements of compromise about them. So compromise is the rule of the game, which does not weaken the fact that we're riveted to the mandate and that we know that we have to stay the course because we are not done.
I remember we had this whole thing and we had to go back and listen 20 times to catch what her name was. I can't even remember.
Aspect of inflation. It's a component that plays a critical role in the service sector in particular, which is far more labor intensive, and where we are looking and scrutinizing evolutions, both in terms of negotiated wages at collective level through unions and manufacturers associations, but also we are trying to really dissect as much as we can, and we have built, as you know, a special wage tracker that now includes 9 countries of the 20 members of the euro area. So critically important, and we know that there is an element of catch-up that is at play now, because obviously most recent numbers were high.
Odd. Her name is Odd.
Numbers matter a lot.
Odd
The fact
Kurselet.
that it went down to 8, well, at least preliminary until we have the German numbers, that it went down to 8.5% in the, in respect of those anticipation by unions or by workers is better in a sense, but it's a critical component that we will be looking at extremely carefully. And I think it's important. I know it's easier said than done, but it's important in those discussions and negotiations that there is a forward-looking approach to what inflation will be.
This girl.
And how soon we will return it back to 2% in order
She's
to
just,
really
she
appreciate
looks smart, she talks smart, she asks good questions. I think she's a really good reporter.
the parties. Thank you.
Thank you. Turning
Like I said, maybe I'm biased because I clearly have a crush on her, but she just always asks good questions.
Over to you, please.
Thank you very much. Could I perhaps ask you to talk a little more about which elements of current inflation developments you're most concerned by, and how that differs from the economic environment at the moment in the US?
Thank you very much. Welcome on WebEx. What are we particularly attentive to in terms of inflation development? Now, obviously, we have to look at energy, because energy has been...
It's funny, we came all the way back.
When
So if I want to get short 3.35, I have the chance to do it again now, right?
Still far too high, by the way.
I think I missed the trade.
We have to look at energy costs because
And I'm really worried about taking it now.
might transmit, and at which pace we don't know, and we will be observing that very carefully into underlying inflation elements. We are looking, as I just said to your colleague, very carefully at wages. Wages will be a significant component of inflation pressure in the months to come. We are looking at fiscal measures. And on the fiscal front, we have seen a lot of measures that were decided and part of the 2023 budget of euro area members. Some of them are going to try to recalibrate, others might not. And we had an excellent discussion with Pascal Donoghue, the president of the Eurogroup, yesterday. He came and participated in our discussion.
No one expected Bond. What do you mean?
Together. So it was a very...
Did you not expect them to rally here this morning?
How the Eurogroup at finance ministers level is going to look at the fiscal measures, is going to look at recommending recalibration in order to make sure that fiscal support will be adjusted to the lower energy prices, which we do not see.
Well, since yesterday. The market was definitely all short, weren't they?
Those are the key components. But what shall I say? On the international front, because I think that you raised a comparison with the US. I'm not going to compare with the US necessarily, but I need to bring into our consideration the international environment.
A little bit of buying from there.
The
So
consequences of the Chinese authorities'
there's the
decision
pushback, essentially.
in December to do away with zero,
No,
to reopen the economy, come what may, are going to come with
I did add her on LinkedIn.
consequences on demand, consequences on demand addressed to the rest of the world, consequences on exports, but also consequences on the price of commodities. If you start looking at the price of metals in particular, there has already been an anticipation of how commodities are going to rise as a result of the Chinese reopening. So there will be inflationary, disinflationary forces the exact detail of which I believe I will be able to say a bit more at our next March meeting, because we will be looking into that in the next few weeks. But that's also a country, the role of which we will be looking at very carefully.
Nothing sneaky about it. I sent the connection request, and that was all there was to it.
Spanish Negocios TV channel.
Thank you so much for having my question, for taking my question, Mrs. Lagarde. I know you just said you're not going to compare with the US, but
so this girl, she's got reddish hair. It doesn't appear to be her natural hair color. It is really, really hard to get that shade of red dyeing it.
And
I want to know how she did that.
Primarily
I know some women that would like to know how she did that.
Does this mean that the decrease is not due to the actions of the ECB? Do you expect the 2% in the medium term? And what is exactly the medium term?
Also, our friend right here,
Far from
the guy that kind of looks like me, bro, shave it off.
I think that's what we are seeing in the bank lending survey, in the cost of finance.
Just go full bald, man. I promise you, you won't look back.
Our monetary policy and our interest rate hikes decision, clearly. So that is definitely working. But it's also true that a large portion of that too high inflation was attributable to the supply shock provoked by very high energy prices, and one that we did not really capture so well, which was gas prices and the impact it had on electricity cost. So we have to be attentive to those energy components, and we have to be attentive to the pace of transmission and the pass-through of those costs into other inflation component. But I would certainly not say that the disinflationary process at large and without qualification is already at play. When I look at core inflation, which is, by far not the only component that we look at many more of those. But when I look at core,
Here's the S&P 500 start. So ECB is going a little over again.
Moved up to.
It's happened last time too, right? Oh, wasn't it last time they went to 745 and we're like, why?
That core inflation has been.
Well, let's see what happens.
So
I bet you there's going to be at least an attempt in the S&P 500 for a gap fill.
And more so than we had expected, and that many had expected. But underlying inflation pressure is there, alive and kicking, which is why we are committing.
You usually don't hear it because it comes through the wrong speaker, but
we intend in this monetary policy statement, and this is why I say that we have more ground to cover and we are not done.
Thank you, Madame Lagarde. And the next question goes to Jan.
And at the same time, 1,000 lot just showed up at 25.5.
Hello, Madame Lagarde. Thank you for the opportunity.
I couldn't find a good bell.
In your statement, you described the
I missed the guy's name.
risks to the inflation.
Did you catch the guy's name?
As balanced.
No, I say more balanced.
More balanced compared to December. Could you say something about how important that is for the future rate path? And my second question also relates to that. Was that controversial
which
within
is why we are committing
the council? Were there different views about that?
Intending as we intend in this monetary policy. Thank you very much for your question. I think the whole paragraph that you have in the monetary policy.
Hold on a second. I'm going to try and catch his name here.
Thank you, Madame Lagarde. And the next question goes to Jan Marlin of Handelsblatt. Jan, please.
Can't understand that name. Did you catch that, Kevin?
In which way is this risk assessment more balanced? Not balanced. We don't think.
Did you catch what his name was? That sounded like that was German. Bundesblatt?
For sure. And it lists the various points that are upside risk, downside risk on both account on activity and inflation.
Why do you want me to look at NASDAQ?
Governors around the table of the governing council.
I should have a bell on the wall.
Interested in
I would always forget to ring it.
as well-based.
Okay, hold on. We'll go back a little bit.
as we are intending, as we intend in this monetary policy statement.
I'll turn it up really loud.
More ground to cover, and we are not done.
Okay, let's be right here.
Thank you, Madame Lagarde. And the next question goes to Jan Marlin of Handelsblatt. Jan, please.
Jan Marlin of Handelsblatt. What is that? Oh, we're going to still catch up over here.
Is about the BLS survey.
It is a German name. But what was his name?
In the medium term, do you see that? And the second one is about the TPI, the transmission protection instrument that you mentioned in the statement. In this case,
Yeah, at least catch the name of the outlet.
Market turmoil in the bond market. Thank you.
Thank you very much for your two questions. On the bank lending side,
Jan Marlin.
as I said to one of your colleagues, we draw a lot of conclusions, learning, understanding of how our monetary policy, and particularly the interest rate policy that we have developed ever since July, is actually...
Yep, that's my boy.
Via the banks.
That's my boy. Ah, thank you so much, Kevin.
And
I am making it my new purpose in life to get this guy to shave his head.
In a way, efficient
Telling you, bro.
and necessary.
It's so much better.
We are trying to do
Just shave it off.
and bring it back to 2%.
They definitely reacted to something she just said there.
The transmission protection instrument that was put in place, just to refresh our memory, because that goes back to June, was intended, sorry, July, wasn't it? Anyway, it was about 6 months ago, was intended to protect the transmission
He's got a Twitter
throughout the entire euro area. And it is available, it is there, it will be used if necessary. It is not the first line of defense. As you know, we have flexible reinvestment under the PEP as the first line of defense. If we were to see that transmission being impaired for non-legitimate reasons, but it is there and it is available. We don't see a need to use it at the moment.
You were about to place an order.
Should it be needed, we will indeed use it. Thank you.
Thank you. And the next question goes to Takari Minami of Nikkei. Takari, please.
Good afternoon. Thank you for taking my questions.
Good afternoon.
And the investors and the financial markets expect that the ECB will finish raising interest rate in coming April, for example, by the meetings in May. So, as you mentioned, I know well, so it depends on the coming data, but do you think such expectations are correct or wrong? Thank you.
You know, I'll go back to what we intend to do, or what we actually shall do, not intend to do. We shall return inflation to 2% in the medium term, in a timely manner. And we know that to do that, we need to move into restrictive territories, into restrictive levels. And we know that rates are the best tool in order to do so. So we will use interest rate hikes in order to get to those levels. And as I said, we are certainly not there now, nor will we be in March, given that we will rely on inflation, underlying inflation indicators and pressure that we see very, very clearly nowadays. What will happen next, as I said earlier on, is going to be a factor of how much more ground we need to cover, and there will be ground to cover.
I think it was when she said,
it will be data dependent. We will look at
rates must be raised to restrictive levels. We will not be at our peak in March. That seems to be what caused the reaction.
And where we believe we need to be in order to deliver on our commitment. But that will not be enough. We will have to stay there. So it's moving into restrictive territory because we know that's needed, given the elements that we have. But it's
I mean, the overall thing that I'm seeing here is that it seems to me like the ECB is still going to be raising rates in May. That's what it sounds like to me.
that we will stay at target. So I hope that that satisfies your question. I'm tempted to ask you a question because we've been debating as to when the governor of the Central Bank of Japan, my good friend Mr. Kuroda, will have to step down. And there was big discussion internally in the House as to when it was, but you will tell me later.
What? Wait, what? Did she really just say that? You should not have said that, Lagarde.
My question is following my colleagues too. It's on December you said that the ECB was going to raise rates 50 in
Okay, whatever.
Possibly 50 March and possibly maybe in May. I was asking you like how it's seen now May, because I don't know if it's less
I know. I mean, we are seeing some selling here and everything, but they're holding the 3.35 in micro pence just fine.
ESG bonds are constantly linked with greenwashing. How will the ECB manage the increased reputational risk implied by tilting bond purchases?
I think that the flows just get more complicated from here because you've got opposing flows, right? I think these guys that are unwinding, it's probably going to continue all day.
I think in December we mentioned significant, we mentioned steady rate, steady pace. In a steady manner, I think that's what we had used. And I said later on that our determination should not be doubted. It was 15 December, 15 February, we're doing it. And we intend, which is...
Bull margin during Powell's speech? That is degenerate,
to do
dude.
50 basis points based on the underlying inflation pressure that we see, anticipate, and are not going to go away. I'm not suggesting that it will be steady pace for an ongoing basis. What we're saying here in this monetary policy statement is that we will assess the situation, evaluate our monetary policy path on the basis of our projection. It might be 50, it might be 25, it might be whatever is needed, whatever rate is needed. I should say whatever rates are needed. We have 3, and then at whichever pace, in order to deliver on our 2% inflation target in the medium term that we want to reach in a timely manner. And we are far away from that. Inflation is still far too high today, in particular when we look at underlying inflation components.
See, like Powell said similar things, but do you see the difference in how Powell said it and how she's saying it right now?
Risk of greenwashing. You know, as determined as I've always been, and you know me, it's been
only $100. Well,
3 years now. So as determined as I am to deliver on our strategy review and the action plan that we have all agreed around the table of the Governing Council to deliver...
Well, it would have been a good trade yesterday, huh?
Paris.
But it's given a lot today, isn't it?
Agreement. Equally, we have to manage risk. And managing risk, to me, is having as
Look at the dollar surging here.
Transparent information and disclosure as possible, a good understanding of the transition plan by the corporates that we eventually reinvest into, and a good understanding of the footprint that they have. And it will be on the basis of that analysis, our own, and also reliable analysis that will be provided by experts, that we will orientate our portfolio with a stronger tilting than we had so far. But we will be very attentive because it's just, we should not be accomplice to greenwashing, and it's a risk management principle that we have to comply with.
Thank you. And the last question is for Eric Albert of Le Monde. Eric, please.
That was full cowboy in his speech yesterday? Oh, I don't know about that.
Mrs. Lagarde, I'm here. A couple of questions. I'd like to come back to the fiscal message, the message you want to send to government. You said they should recalibrate. Is it really the right time to pull the plug when food inflation is at 14%? And energy prices are indeed going down, but are still hurting a lot of households.
I really think that overall, Powell does not typically want the market to react strongly to his comments in the press conference. He doesn't necessarily view the press conference as the forum to really shift the markets per se, but rather he views that as the opportunity to explain their policy and to make sure that the market understands their policy correctly. So he works very, very hard to say things without saying anything, you know?
Good understanding.
So if you're following the monetary policy closely like we are, his comments usually aren't very surprising. And I think that's because many of the times in the past where the market did move strongly off of the comments that he made, it wasn't intentional. There's like been a number of times where the market moved off of something that he said and then they had to like do damage control, I guess you could say. So I think that the market has a tendency to misinterpret him. But at the same time, they gave him lots of opportunities to be hawkish. So he was definitely a dove yesterday.
You know, it's not asking governments to speak now, but they clearly have to align their fiscal support with the energy
I
price
guess you could
impact
call it
at
manipulates the
retail
market.
level.
But you got to be careful with the word manipulates the market because that means something very specific in the law, right? Manipulating the market would be creating activity in a stock to give a misleading impression of the supply and demand in that stock.
September, voted in December, and the measures apply throughout the whole of 23. And you know what if that recalibration does not happen for those measures that were not subject to variation of energy prices and therefore would automatically adjust, then the other measures should be thought through and reconsidered, not with a view to remove the shields, but simply taking note of the fact that the shield is not as badly needed as it was. So I think that's the...
We should be getting close to them ending the conference.
Advocacy to governments, and it's something that we discussed with the president of the Eurogroup yesterday in particular. So on the monetary policy decisions that we are making, as I said, we are riveted to staying the course, to move into restrictive territory sufficiently, and for long enough so that we're confident that we return inflation to 2%.
The word manipulation gets a bad rap.
Some good news, because growth.
Well, yeah, because retail traders act like stock manipulation is your orders having an impact on the market, which that's not what it is.
I'm looking to say that, well, if you take this out and this out and this out, it's not so positive. I think we should celebrate that we are not in negative territory on the growth front. Headline is going down, which I think is going to be important, in particular for the wage negotiations that will be coming up. But we still have underlying inflation factors that are strong, solid, and are not budging. So we need to do our job. We need to deliver on our mission.
Thank you. That finishes the press conference. Next meeting and press conference is 16 March. Until then, all the best to all of you. Thank you very much.
Good press conference. Good press conference. I thought that was better than the last one. I don't know. They've done that. I think that this is just the new normal. It always used to be that they would start at the bottom of the hour and then they'd go until the S&P. But I guess they decided that they need to be speaking while the American equities are going too for a little bit. So I find it very annoying as well. Well, where do we go from here? I must say the bull run that we had this morning was incredibly impressive. And I could see when it was turning around the opportunity for it to go down. I'm actually surprised that it came down as quickly as it did. Like, of course you're going to fall back through here because the liquidity is going to be damaged all along here, right? But now almost pushing the lows of the day is actually quite a step up from the pace that I thought we might have. So now I could potentially consider shorts, but I'm still concerned that the overall flows are going to be to the long side. There's just a massive amount of people short. I mean, these interest rates, 3.35 makes 0 sense. Okay, 3.35 doesn't make sense. I don't see how you prevent inflation from coming back again even harder with an interest rate 3.35. But you know what doesn't matter today? What matters today is there's all these guys that are short and are covering. So there you go, B. I am done. I quit. Wait, what are you talking about? Let's not use derogatory names for Mrs. Liquard. She tries her hardest, okay? She tries hard, and that's all we can ask. She is the president. That's what it is. We should be respectful to her. Anyways, I mean, should I try taking a long? I don't know. Now, the way that the S&P, the SPOOs are acting is kind of interesting too. That selling on the open does appear to be like a gap fill attempt, but kind of short-lived and not very much volume on it. Oh, and it didn't go well for you in Argentina with her? How's that? Oh, that's right. Okay. Mm-hmm. What the hell? Jack Prosiviak just tweeted, Chris Christie saw his shadow this morning. 6 more weeks of cheesesteaks. Oh, I'm down with that. Love me some cheesesteaks. Love me some cheesesteaks. Well, see, here we are, 3.35. They're like, Seth, that's the price that you said you wanted. Why don't you just take it, Seth? That's what he's sitting there saying. I am still seeing the volume slightly to the long side. But it's a little suspicious. I can't quite put a finger on it. I feel like I think the reason why I'm hesitant to do anything is because that was weird. Maybe a little bit of a steepener there. I feel like that I had a move like a flow that I was able to predict really well, and that flow already came through and then price completely retraced. So like, what reason do I have to take another trade? It's very doubtful that there's more to that meta order, you know, if it completely comes back like that. Because if they had more, they would certainly have started buying more of it. They also kind of had a bit of like the volatility was kind of starting to increase. So I don't know. I am seeing really massive. Yeah, this could have some legs, guys. I don't know. The Japanese yen is really falling hard, and that appears to be driving this downside action in the treasury at the moment. I also saw the S&P 500 flipped back down really quickly as well. So maybe this does have legs, this downside here. There's something else is going on. some sort of a money flow that we weren't necessarily expecting. And you know what? If we do get a move to the downside, because we had such a massive move yesterday, there's no telling how far down it could go. You know, although, you know, here in the Treasury, we're not even getting into like crazy levels until 115.10. 115.16 would just be like, you know, just before the open. So while we are seeing some selling in here, I mean, it looks like the 30-year might be pushing harder. It does still look like steepening, but we'll have to see. Look at that. Okay, so a lot of volume exchanging hands at 3.365 in the micros. Well, see, so far it's still pretty quiet. Let's read Trader Brand. The conclusion summary from all three central banks is this, and I think it's extremely important to recognize. If you look at the bonds after the Fed, dovish, the Bank of England, dovish, and the ECB, hawkish, the outcome in the 2/10 curve was exactly the same, both flattening. What this means is massively important for markets going forward, and in particular risk markets. The message sent is markets are telling the central banks they can be hawkish, they can be dovish, but higher rates will pull forward a recession. This is a simple message from bonds. Take note of this because risk markets are moving away from a rates narrative and into a growth narrative. Soon enough, you will see a day where bonds bid and equities sell off hard. This is Brannigan's prediction. Oh no, Twitter will shut down free access to its API for third-party developers, the latest effort to bring in revenue at the money-starved social media site. Yeah, free access to Twitter was... I was always surprised that they kept it free. That's why so much data science had been done on Twitter data, because the API made it free. Now, as to Brannigan's assertion that it was flattening, the thing is that we steepened during Powell's press conference. So, I don't know. Not quite following what he's saying. I do agree with him that the markets seem to be moving away from a rates narrative and going into a growth narrative. I'm still very much concerned that you could see a market that flips very hard on itself. That sort of a thing, you know? Because there comes a point where, you know, it's the stock market just gets ahead of itself too quickly. Right? The equity markets can only go up so much before it requires a more forceful response from the Federal Reserve, right? Well, that's pretty good 4 ticks down and stacking there, so... It's not quite as aggressive of movement as we were getting earlier on the upside. And again, this appears to be driven by the Japanese yen. So these bids aren't necessarily jumping out of the way, but they're just getting creamed there. Look at that. It's really curious how quickly they just turned into like outright hardcore selling, isn't it? Well, it looks like they might take a break there. Let's see. Yeah, there's definitely a decent amount of buying there. I mean, the deltas, the cumulative, the volume, let's say that the volume in dimes has definitely been to the downside, but it's been pretty gentle. They went from 128 to 118, so about 10,000 contracts short. So that's really quite mild compared to the upside that we saw, because the upside starting from just before the open went from about 104 to 137. So let's say 35,000 contracts, right? Was a lot of contracts long. And you can kind of see here, even though it looks like we got everything right and everything, we didn't really make very much from it, did we? So we got big icebergs, both sides, 18.5. But we got news, don't we? Okay, yeah, we're gonna have factory orders here. Expectation 2.3%, core durable goods -1. Okay, factory orders 1.8 versus an expected 2.3.
5.6% as expected. Core durable goods.
Well, those numbers appear dovish. The market's not really reacting to them though.
Minus 0.1%.
Curious.
We're seeing some comments from the IMF, who said that central banks must ensure that a policy remains appropriately tight long enough in order to durably bring inflation back to target.
That's a little weird, the volume, that volume that we saw here.
Also says that service inflation...
Just before that news and everything, that's a little weird.
Slowly. And that central banks must avoid a misread in sharp declines in goods prices and easing policy before services inflation and wages moderates markedly.
Okay, so now the IMF is putting a note saying central banks need to be careful to not read the decrease in the costs of goods as, that you can let things off because you're still seeing inflation in services. So what the central banks were already saying, but the IMF noting it too here is really curious. Well, I'm not a huge fan of the amount of sell volume we've seen here. Or sorry, the amount of buy volume we've seen here.
Note in the prior revision on US factory orders, minus 1.9% from minus 1.8%, so a slight downward revision.
Does appear like the Japanese yen is still selling though.
We've posted the US factory orders report for December 2022 on the feed for those interested.
That's interesting. It's going back and forth there a lot. Not liking the 30-year there. I'm catching a hint of flattening here. Yeah. I dragged the 30-year with them there, that last tick. Bonds are trading like oil super fast. Well, it's nothing compared to oil, but it's definitely been trading at fast pace. I think one of the things that can make treasuries really frustrating, but I think is also really good training for a trader, is that you'll often see it as like, okay, we're in a range, nothing's happening, not a whole lot of volume comes through, and then, you know, maybe you see a little bit of something, but by the time that you're certain that like the orders are going a certain way and that we're having a move, like it's already moved. And sometimes it can just move really quickly, you know? It can just do that so quickly. And so really in the bonds, I find that trying to trend follow just doesn't work. Seeing, oh, it moved up a little bit and we crossed the moving average or whatever, and we want to see it go through and all of that sort of a thing. Like, the instrument is just too efficient for that. By the time you notice that happening, it's too late. Well, they sure got back down to the lows and new lows in the 5-year awfully easily, didn't they? Some volume there in dimes at 17. Good offers. Not that time. There you go.
So just keep in mind, in 10 minutes, 10:15 a.m. Eastern Time, ECB's Lagarde is slated to speak on the ECB press conference.
So that's the whole thing. Is you can't just sit and try and follow other people. Trading is not about following other people.
10 minutes time now.
The trading is about predicting what other people are going to do and doing the thing before they do it. That's what trading is. Yeah, there was another little further push down in the Japanese yen. The yen may have, if they're gonna like retrace all this, well, the low in the yen is still if they're gonna go to the lows of the day, we're maybe 2/3 of the way there in the yen. But I should note, by the way, that the cumulative delta did not really move on that downside move in the treasuries. So we're still kind of in a, I don't know. Seems the gap fill stuff has become favorable again. The gap fill is something that I think is common enough and enough people know about that you're always going to kind of see action around it. It's just like whether you can make money from it and hold risk for the trade and everything is a completely different matter, right? I think we see that a lot in markets where when there is a market behavior that does seem pretty common and obvious to people, it's hard to actually make money from it because you have to put on a crazy amount of risk to actually hold the trade through all of the twists and turns that it gives you before it actually does it, you know? Like, I feel like the way that the market works is like it kind of comes, it's like it's quiet, and then, you know, the volatility just goes more and more and more until pretty much everybody except for the largest player, it's too much. And then that largest player wins and we start the cycle all over again. That's what I feel like markets do. Like that's what they do on a longer time frame, and I feel like that they do that on a shorter time frame as well. So it's just kind of like we're gonna chop around until everybody has to give up, regardless of which direction you're at and all that. Okay, so there's a significant uptick there.
Just keep in mind that top economic advisor to Biden, Deese, will step down this month. Then again, that's Deese, top economic aide to Biden, stepping down this month.
We're getting a little bit of thickening in the book here too. So, yeah, okay. There's that stack there at 17 in dimes at 2,000 contracts that it seems like somebody is trying to shove it away from it. Well, and it just pulled. So there you go. There you go. Ooh. Ooh, the 10-year did not like that. See, there I go, calling it the 10-year again. Dimes didn't like those. That's good. That's good for us. Am I getting the volume though? Not quite. I think it's just mostly moving in correlation with the Japanese yen. So that could mean that it could be difficult for us to find good profit-taking places, right? Okay, that's good. And some more volume in micros, that's good.
Again, ECB is due to be speaking on the ECB podcast regarding the monetary policy decision just made.
The ECB has a podcast and they're going to talk on it now?
And things that we heard during the press conference. But just
I'm sorry. I am all in on the lifestyle and everything, but I'm not listening to an ECB podcast. That's too far. That's a bridge too far for me. I'll let the Europeans, you can listen to the podcast, tell me what they say. Okay. I'll take my profits there. So I think we're certainly in a situation where this could either continue a good clip lower, or it could completely reverse. The thing is that the flow, it seems to be that's driving this again, I think is coming from currencies. So what that means is that you've been getting these pullbacks in the treasuries that are a little bit steep. That's why when I was seeing some good liquidity there to get 15 ticks, I took it. Because I'm worried that if it comes back to here, I'm going to be like only taking 5 again. Right? So essentially, I'm making the determination that it's probably better to get out early than to get out late in this situation. And look, there is some volume trading here at 15.5. 16 was also kind of like, you know, a benchmark area. So it's not stopping yet though, right? It hasn't given me the signs. That was an earlier exit than I would normally do. You know what? I also think that I'm probably being overly cautious because of the losses that I took yesterday. Which, you know what, thinking about that, I thought about that a lot. So I was like, what do I need to do in that? Why did I do that and all that? And then I realized, you know what, I was on my medication. And I really shouldn't be trading like that off of medication. I'm just not going to be as picky about my entries, and I'm just not as tuned in when I'm not on the medication. So that was really the mistake that I made that screwed me up. So that's what we need to do next time. Next time it's an FOMC, I should just not be touching it. Or if I really strongly want to touch it, like I really want to have a trade set up, I should take medication before, right? And I certainly shouldn't be taking multiple trades, right? Or big losers. There needs to be something where it's really clear what direction it's going. And okay, so we are getting the pushback. See, that was I'm not going to say that it was an amazing exit or anything, but I did get what I thought I was seeing there. So I'm just pointing that out as like a note to myself that my read does seem to be pretty good today. I'm able to see the flows and the points where they're going to turn and so forth, even though I don't 100% know what's driving them. This sell, I don't completely know what's driving it. That selling in the Japanese yen is a little, I don't, that just kind of come out of nowhere. Might have nothing to do with anything. So how's the S&P 500 doing now? So SPOOs are declining. It's not too bad. I mean, they're still above 4150, which is just sounds so crazy to me. When I look at the one that concerns me the most, this is the thing I'm seeing in the market right now. So again, what we want to do, we want to look at all the markets, see where the money is going into, where the money is coming out of. What does that possibly tell us about the macro environment and our theories as to what are driving those flows and so on and so forth? Okay. This was a process that I was taught when I worked at the bank by the traders. So, the one that's weirding me out the most right now, if I can come over to the charts here, is oil. Oil was down big yesterday. That was all before the Federal Reserve meeting, by the way. And now here this morning, we're getting another large sell. And this is during the active market hours that this continued sell is going. And also in a place where the equities aren't doing so bad. You know, treasuries are moving a lot. Yeah, that's a little odd, don't you think? That the stock market is going crazy and the interest rate market is going crazy, but the oil market is kind of saying we don't see as much demand. That, I think, has to give you pause about everything that everything that's going on in the stock market. Like I demand destruction in oil. Yeah. But why would that be if the economy is looking good here and the Federal Reserve is going to be easy? Shouldn't that increase demand in oil? But they don't think that it's going to come through, I guess. That's what's curious about it, right? I think that this situation that we have right now, we should just remember that there's so much interest in this event and there's so much volume that has to come through that it's very, very likely that we get big pushes that really push us far away from what fundamental value would be, right? In other words, the market is likely to become overbought here. The treasuries are likely to become overbought here as well. They had a build yesterday. Okay. So this is, you know, look at the way that this freaking happens, because it does it to us over and over and over again, right? It's like, you know, back here at the beginning of December, things were looking really hot, right? And then all of a sudden, all it took was like 3 days and we were all the way back down at negative 20% again, right? So you got to be cautious right here. This is a place where, you know, if it was going to turn back down around, it could totally do it here. And by the way, look at there's definitely This 41.75, I don't think that you should be going in and trying to play, okay, here's 41.75. I think that it's going to be resistance, or it touched it and it came back, so now the move is short in the treasury, okay? But just it coming back across that point does kind of tell you a little bit of something, that people are a little nervous about seeing a higher high, right? Because from the macro economic indicators that we're getting kind of say that things aren't actually so hot, you know? So I've wondered, because we were talking about this whole thing, like, okay, the jobs market appears to be really strong, but all of the other economic indicators that we're getting are really, really negative and look really, really bad. So it's like, we're not like in a straight up recession, but it sure seems like we're headed into one. But then it doesn't happen. The jobs numbers just continue to be really strong. And I'm wondering, is it that, well, so one theory has been that the jobs numbers are bullshit. Right. And there's some substantial evidence to suggest that the jobs market is not as strong as it appears. Right. Okay. But what's the alternative? It seems to me like the only other alternative is that we're just seeing the effects of the monetary policy in some parts of the economy and not other parts of the economy. In other words, we are seeing a slowdown in manufacturing and new orders, but we're not seeing a slowdown in employment costs and in services, right? So I think that's not a good situation, right? We're essentially gutting our manufacturing base and not actually fixing the problem. If that's the case, it's a little scary to think about, isn't it? A little scary to think about, isn't it? Well, they gave me a good trade. I almost feel like with the way that one played out and everything, I kind of feel like they did it just for me. They're like, that's okay, Seth. You can go short. We'll give you a little bit more.
Forecast minus 100.
We'll give you a little bit more.
From the prior minus 91 BCF.
They haven't quite come back, but look, this is exactly what I was worried about, right? So that I'd be at 365 and being like, well, okay, maybe I guess I can take 5 ticks. So I read that flow really well. See, I would always make this mistake where, you know, when we get into this kind of a market, you get a lot of volatility and it's really easy for it to come back. And so what would I be doing? I'd be trying to hold on to it. I'd be like, well, it come all the way back, but then they could have another run and they could certainly go for the high. And, you know, I'm really trying to get it to run when really what I need to do, when really in this situation, it's really hard to get a super persistent flow, you know? So when you're getting the profits, you really probably should take them quickly. Now, the downside to that I shouldn't notice. See, this is not me trying to teach. This is me noting to myself what I've picked up here. The downside here is that if you're taking relatively small profits, right, you're likely to catch winners and feel like you're getting it right. Yeah. I mean, in this one, the trade that I took only had 3 ticks adverse, and I don't even think that any volume went through. So I definitely caught it right there. But that's kind of the thing that we need to be careful about. Like, we would think that this matters and this matters, but we can't completely see the full picture. But I do think I have enough experience to say that once you get into this point where it's like there's the big move and then there's kind of the aftermath and things start to get volatile, I have a tendency to want to start getting them to run. And it's probably a better option to take the quick profits in those situations, right? And you can kind of see how it starts to work through once you consider the stylized behavior of markets, because you're going to get like these big moves, big meta order, and then all of this behind it is been eaten away. So if somebody tries taking it the other direction, it's going to come back very easily. And on a day like yesterday, they're all going to be in one direction, so it just keeps going. But on a day like today, you know, the speculators, they already got in. Clearly somebody was taking off a huge position earlier, but that's over with. So then what drives us from here? And you can see flows both ways. So we should be taking quicker profits. Oh. So Punxsutawney Phil has predicted a long winter. Nick Timmeros, IMF note from Tobias, Ariane, Christopher, Erag, and Fabio Natalucci. Central bankers should be cautious about ratifying recent loosening of financial conditions because investors may be too sanguine about progress on disinflation. Yep. So here's a question. Did they write that note before or after Chairman Powell spoke yesterday? Because one could read that note from the IMF as a note to Chairman Powell that he really needs to bring the interest rates back up, right? They need to say something to stop this decline in interest rates. All my buddies in the futures, they're getting slaughtered. You got to do something, Powell. That's what's really going on. That's what's really going on. Oh, you know what? By the way, got a question for you guys. So a lot of you pulled up that strategy PTF or blah, that strategy PDF that I linked to you yesterday. Actually, somebody put a comment, but it wasn't. They were just testing. They were just screwing around.
The EIA natural gas
so
forecast minus 144 BCF from the prior.
People read it, but they didn't say anything.
BCF.
But if you have any comments on it, I'd love to hear it. I mean, I made some decent progress on it. It looks like this is going to be at least 10 pages. So, and then I probably need to put like pictures and stuff in it. So, but we'll go and we'll make that video. Why you suck at day trading, and some of the content that I write for that might be able to fit in here as well. I was starting to get into current liquidity conditions, and I was just like, you know, blowing my wad on that and saying everything about it. Maybe that's going too far, but nah, I'm gonna explain it all. I'm gonna explain it all and just see, because that could eventually become a book, right? Jim Iorio, you remember when the Fed guys used to have trading positions on in the futures when they released their decision? That was awesome. Yeah, I don't think it was quite like that. There you go. Joseph Wing. This guy is so effing smart. I want to talk to this guy, Joseph Wing. I had some way to get in contact with him and interview him. I would really like to do that. The problem with a data-dependent Fed is that Fed actions directly impact future data. By letting financial conditions to rapidly loosen, the Fed creates the potential for the re-acceleration of inflation. So he's right. The Fed is saying, oh, we're being data-dependent. But by being data-dependent, they're creating a situation where the inflation can come back, right? The economy is doing poorly. We're data-dependent, so we have to back off. They back off, that has impacts on the market, and then the market is right back up there. Like, here's the thing. Look at Bitcoin. Look at some of these meme stocks. Like, the echoes of 2020 are still there. All of that craziness, it's still there. It's like people didn't give up on it. That's the curious thing. This, if this is a recession, let's say this cycle, this interest rate cycle is unique. This interest rate cycle is unique. You've never had a situation where the public was that engaged in what was going on in the markets. And I would have thought that after a year, 2 years, that they'd forget about it, but they haven't forgotten about it. And it seems to me like some of these guys still have money. And it seems to me like these guys have really learned how to take advantage of the options and so forth to create some of this zaniness. And so we're still seeing it. And I think that until you fix some of these problems, you know, so like one of the things is they've got to do something about the margin limits, man. They really need to change it so that the impact of your selling needs to be factored into how much margin you're allowed to have. They've got to make that change. They've got to make that change. And until some of these things are fixed, could make it hard to keep inflation down. Could make it hard. We've also got to fix these problems in the labor market, right? Like this is a big problem when we get so much inflation and people's wages don't rise with it. That's a big problem. And that can only go on for so long before the pay like skyrockets, right? Like under our current trajectory, I'm just spouting off now, man. I should stop. I feel like that on our current trajectory, that it's only a matter of time before every housing market is like California, you know, where all of the houses are worth $1 million and
minus 104.
You're paying ridiculous amounts even for a 1-bedroom apartment. Spoos maybe going to press the highs of the day here.
Draw here.
Treasuries, they pulled back, but they've kind of been sitting here. So we could see another leg down. I think that given the timing, I'm just going to have to be happy with what I got. And if they make another move down, I just have to say I missed it. Because I've got 30 minutes left. Twitter's a little bit quiet today, relatively speaking. Oh, it looks like, yeah, there's the break. Can they break 80? There's some offers stacking there, but look, there's a bid there too. Nutso. This is getting nutso.
We've posted the EIA weekly natural gas storage report on the feed for those interested.
The S&P 500 is just going bonkers, guys. Maybe oil will turn back up. I would feel a little bit better about it if oil was on the upside. Oil and copper. I need copper too. You don't get it, Octavius? What? Why the buying in E-minis? Because that's what the order's got to do. Order's gonna do what order's got to do. If they've got to buy, they got to buy. And it might not make sense. Treasury's pushing back higher. I find it very curious that when the S&P 500 seems to be like on a big I thought I had a better word than this. Ah, my guys, I totally screwed. I was trying to be all, you know, flowery with my language and stuff. It didn't work out.
Index climbs around 3% to the highest.
Oh, we got to mute we have to mute the news squawk. I'm sorry. It seems to me like when the S&P 500 is going gangbusters high, that the treasuries are also buying, which under the current macroeconomic environment is probably not what should happen. Treasuries look like they're headed back to the opening prices. Are we going to see that 3.35 again? They'd be like, we're back here, Seth. You want to take it this time? I think that whole move down was driven almost entirely by the Japanese yen. Okay, Demon is maybe taking a little a little breath there. Do we make income with this? I treat the trading as more of a hobby right now. I've been doing pretty okay lately, but trying to pull in consistent income from trading is really a big pull. Really is a big pull. So I still have a day job, and when I take the trades here, you know, I'm often only making 10-20 bucks at a time, right? So I think so here's the thing, Ek. I think the reason that people ask that question is they're saying, well, I want to learn how to trade, and so I need to go and I need to find somebody that really knows what they're doing, and then they can teach me how to trade. And so I should go and find somebody that's had a lot of success, or, you know, that is doing this professionally. That's going to be the person that's going to be able to teach me these sorts of things, right? You can't take that approach in markets because past performance is not indicative of future results, and it's very competitive. So, you know, if somebody was having a lot of success with doing this, they would probably have their own fund, and you could invest in their fund, and they're not going to want to tell you anything about how they're doing it, right? Because then that would be money away from their fund, right? So what you need to do instead, the approach that I would recommend taking, is an empirical approach. So it doesn't matter what the experience of the person that's been sharing this information with you has been, or anything like that. How much money they've made, how long they've. What matters is, can they back up what they're saying with empirical evidence? For you as a beginning trader, that's the most important thing. Is when you see information, is it backed up by empirical evidence? So I have a bunch of videos on this channel about this proven market behaviors, which is like the stylized behaviors of order flow. Okay, that is backed up by a wide body of peer-reviewed empirical research that retail traders just like completely ignore. That's like very valuable stuff. So that's why you should watch this channel. That's why it's valuable to come in here and talk with me and follow along with each other and everything. You know, it's because we have empirical evidence. Oh, I was playing with this pen and there's the light is on. That's funny. Yeah, Gary's trading. I think that like I haven't taken it, so that's the thing. I think he has a yellow coat course, right, which teaches you some of the basics, like from almost like a regulatory kind of a perspective. You know, this is kind of like the regulatory training is what I would call it. Everybody should take that yellow coat. Like I firmly believe that everybody should take that yellow coat course and pass the test that he has on it before you go and you actually trade. Okay. Gary knows a lot of things because he did trade it professionally. Okay. So he understands how market making works and kind of the things that you are really going to matter to your performance if you're trying a market making style. Okay. But two caveats that I would put to that. Number one, market making is incredibly difficult to do in this environment. So if you're going to take his course, I would approach it from the perspective of, not from the perspective of, oh, this is going to make me a millionaire, right? I would approach it from the perspective of, this is a dying art that we need humans to understand, and maybe someday it will end up being useful and I'll make money off of it. But my primary driving behind learning this is to maintain that art of human driven market making. Okay, so that's the first thing. The second thing is that there is a lot of quantitative research about market making that you can learn that he's not necessarily going to teach you in that course. Okay, so which means that you can find this information other ways. It's just that the thing with Gary is that he kind of knows the important things, and what you're going to find in trading over and over and over again is that it could be this really tiny thing that makes a huge difference to your trading, and because it's such a small thing, you may just never notice it, right? So when I read his old course, I thought that it was a valuable thing, but it was kind of like, well, I kind of already knew all of that stuff, but I didn't focus on this one thing and this other thing all that much. And so in that respect, it was valuable, of course. Okay. But, you know, I wouldn't take Gary Norton's course because Gary says that he was a professional trader and all that jazz, right? That's the wrong reason to do it. You should take it because there's like some empirical evidence behind it. And there is. I mean, he's not in so much of like it's been back tested and there's a peer review study and all that, but there is stuff that he goes into where, you know, it's simple math and logic that proves the conclusions that he's making. So he's not just pulling it out of his butt like most people. Oh, you did yellow/blues, but red is a lot of money, so I was wondering. Yeah, well, and I don't know what's in red. But, you know, if you did yellow/blue, you're probably in a pretty good spot, right? I mean, I think that the key insight he has is that if you don't really know what the future order flows are going to be, then your next best option is to trade your asset against a correlated asset and basically do arbitrage. What he's talking about is basically arbitrage, right? But he's saying, you know, like the robots, they go and they do all of this math to determine if two instruments are correlated at that moment and yada, 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 right? Whereas he's kind of taking more of a macro fundamental approach, and here's all of the things that should be correlated, and based on this, what should I do? Yeah. You've done futures for a while, getting into order flow now. That's good. I have some videos about order flow that I highly recommend watching. I really do believe that what you're going to learn in my course about order flow is going to get you further than any of the other courses and stuff that you see out there, and it's free information, right? And what you can do from there is you've got a lot of information, so that if you really want to go onto the quant side and dive deep on it, you'll have the resources to do it, right? And you can find some really valuable stuff. But like, that's the kind of the thing is that when I go through all of that information, like the big conclusion that you come out with is you need to understand the stylized behaviors of order flows that can help you manage your positions and get better entries and so forth. But ultimately, where the real edge comes from is from identifying informational inefficiencies in the market, because the market is more statistically efficient than it is informationally inefficient, right? So the best opportunities for traders are the easiest opportunities for traders are going to be on the informational side, which is why it's kind of like, okay, you go through one course, a video series. I mean, they're free videos, right? You go through this free video series. That's the main stuff that you need to know about, right? And then you can spend all of your time on the things that I think are really actually going to make you money, which is like reading analyst reports and understanding the current environment and all that. Yeah. You're in data science, so you're interested. Oh, well, that's good. Yeah, you definitely got to check out the man. So that stuff about the stylized behavior of markets, the kind of the gateway to that stuff is this book called Trades, Quotes, and Prices: Markets Under the Financial Markets Under the Microscope by Jean-Philippe Bouchot and Bouchot. The way the French say it is weird. And basically what that does is it's a good summary of all of the market data research or market microstructure research we've done in the last 30 years. And what I'm doing is I'm just kind of summarizing that information and explaining how to apply it to retail trading and how it's relevant to your retail trading is what I'm doing, because that's what the researchers never did. But so once you've read that book, then you can go on like archive.org and start reading like the most recent studies that have come out, because there's new stuff every month, man, to read. And you can just read studies about this stuff all day. So it's like once you have that base foundation to understand what they're even talking about, then all of a sudden it's like people are just releasing mind-blowing stuff all the time. If your course is that good, why aren't you making money yourself? So think of it like, again, Ak. So like, let's say that there's this level, right? Okay. So you need to be yay high to actually make money, right? And a person that comes into the market and doesn't know anything, you're like way down here. Like you're not anywhere even remotely close to being able to make money, right? And all of the information that I can give you, these proven stylized behaviors of markets, these are things that the people that trade at the big banks, like they understand this stuff like the back of their hand, like way better than I do, right? So all of the information and everything that I can give you and all that edge can kind of put you to here, right? And then if your psychology and everything is good, and you have good information, that is, you have a piece of information that is being underpriced by the market that predicts the future orders, then you can kind of get to here, right? And now you're above that level where, you're going to be profitable. But like, here's the thing. It's only like this much. It's only like this much. So like, how much are you actually making off of that? It doesn't seem like it's very much, right? So the implication would be, Oh, well, or the implication in your question, that is to say, is it would be, well, if your methods are so good, then you should be making millions of dollars from it. Well, no, that's the sad thing about it, is that you can be insanely good at this and hardly be making anything, because the amount of edge available to a retail trader is just so small, right? If you really want to make money from it, you want to go and trade for a bank, right? I don't want to live in Chicago or New York, or maybe I would go and pursue those kinds of jobs, right? So, not million. Well, you could make million. I could make minimum wage from this, yeah. If I had a 20K account, I think that I could probably trade it and make 20K out of it a year. It would be tough, because I mean that's a lot of risk to put on to double your money every year. But we could, with the leverage that we get in futures, we could probably pull it off. But think about that. All of that effort, all of that, it's still only minimum wage. You know, do you know traders who make 10 million a year? Do you know traders that make 10 million a year 5 years in a row and they can back it up with statements? It's 100% a year. Well, I don't want to put on that much risk. yeah. If I had 100K, then so like me, I don't believe you. I think you're full of shit. To be honest with you. I've seen a lot of traders. So the thing is that usually, this is kind of the funny thing about it, is that when a trader is having massive success, so you're talking about people that are making millions of dollars a year, and they're a retail trader. Let me be clear, like they're a retail trader, okay? It is more likely that they got lucky than it is that there's actually like information behind it. Yeah, if you can show me 5 years worth of statements, I would be so, because in 5 years, I can't tell you how many times I've had people come in and either claim that they were an insanely profitable trader, or they claimed that they knew somebody that was a profitable trader and then didn't back it up. It happens every freaking week. And nobody ever wants to show the broker statements because they're full of shit. But yeah. Anyways, my point was, you've been lied to, guys. Like straight up, what the public and what the media tells you about trading is total bullshit. Okay, they're following people like in the early, 2020. Or not 2020s, but the early 2000s rather. All these stories from people in the early 2000s that kind of took advantage of the advent of electronic trading before the robots came in and made millions of dollars from it. And that is like what everybody gets in their head, that's kind of the success that I should be able to have from trading, right? Or from day trading in particular, right? Other sorts of strategies. Other sorts of strategies are different, right? When you're getting into like swing trading strategies and risk parity, I mean, the sorts of things that hedge funds do, they hold positions further than a day, okay? Like that's a different thing, okay? But coming in and trading treasuries every day, it's hard to make a living doing that, okay? There's only a few people, like I'm literally talking like less than, like a handful of people that are like really doing that in this world, and then the rest of it is robots. Okay, so, and the chances that you'll be able to talk to them are very, very low. Daniel from Church, never heard of him. I never heard of him. But I'm gonna bet you that they don't meet my standard. So I don't buy into competitions. He has a big Bitcoin on his in his face, so that right there has me like, well, okay, right. So here's my metric, okay? Here's my metric, okay? You day trade every day for 5 years. And at the end of 5 years, your Sharpe ratio, I know that Sharpe is like a really flawed metric, okay? But your Sharpe ratio is above 0.5. You can trade for 5 years and have a Sharpe ratio above 0.5. That's worthwhile. That's worthwhile. Never seen it. Most traders don't even know what their Sharpe ratio is, right? When we worked at GS, how much were the traders making? Actually, not as much as you might think. I mean, obviously, there are some that are making millions of dollars. But the people that I was talking to, they weren't making millions of dollars. I think I recall them making maybe double what I was at the time. It wasn't fun. I mean, I think that they were in the, you know, it really depended. It really depended on the year, right? No, I'm not profitable over 5 years. I'd say but we've only been doing it in this kind of information. So like the thing is that we came across a bunch of really good empirical information like late 2020 that really adjusted how we traded. So it hasn't even been that long. But I think you're kind of missing the point though, right? Because what I'm trying to tell you is you're trying to listen. It's I'm a little ADHD, so I get into this all neurotypical, neurodivergent sort of a thing. You're doing the neurotypical thing, right? The neurotypical thing. We're social learners. You want to say, who has the authority? I'm going to go and learn from them. And I'm just telling you, I don't hold myself up as some outperforming market guru champion sort of a person. And I think that anybody that's out there that is holding themselves out as that is probably full of shit and selling something. A lot that it's wrong to sell things, but I'm just saying that they only put this persona on because that's what people respond to. People listen to you if they think that you're making a ton of money from it and they can make money from doing it too, right? But what am I telling you? My performance, it doesn't matter. What you should be paying attention to is the empirical evidence. I'm giving you something that all the power is in your hand. It's proven information. And once you have that base of proven information and you understand like how they're doing that and you develop those tools yourself, you can do anything that you want. And you could go and play, you could go and get a job with the banks and trade for the banks or whatever the deal is. That's the kind of information that I'm giving you, right? The past performance is not indicative of future results. Look at the empirical evidence. It can't just be altruism. Well, I was honestly, it was mostly just chance. So like the way that this all started was there was a contest to do a video trading journal and the winner would get a NinjaTrader license. And so I started recording myself for that, and I was the only person that did it. I was the only person that entered the contest. Okay, this was like 2017, right? Or 2016. I was the only person that did it. And because of that, a ton of people started watching, subscribe to the channel because I was the only one. And that was kind of how the channel started. And from there, it was almost like, well, I was obligated to just keep going. And then they gave us streaming, and our channel blew up from streaming Bitcoin futures, and it just keeps going. It just keeps going. And then, I share the information I get. The thing is that when I get this kind of information and I share it with you guys, I do get benefits from it, right? Because, well, I mean, you make money from the advertisements from YouTube, but the thing that's really valuable is that then people find other stuff and they share it with me, right? And especially when you're going from day to day, and, we talked about, again, the key thing is what kind of informational inefficiencies can you identify that you can use to predict future orders that it's maybe underpriced by the market, right? having this community together, we can find those a lot more effectively than we can on our own, right? So that's the benefit for me, is that I benefit substantially from creating the community. In other words, I wouldn't be able to trade as well and in the way that I have without the resources that are provided back to me from running the community, in terms of the information that people give me, right? But again, it doesn't really matter, right? All that matters is, if I share a piece of information with you, can you verify that it's true? They have empirical evidence, right? Because any piece of information you can get about the market that you can prove is true is potentially valuable, right? And the difference between me and everybody else is I'm going to show you where I got it from and prove to you using empirical evidence that this is the way it works. Whereas everybody else says, here's this technical pattern and you just trust me, it totally works. And then everybody loses money trading it. And they're like, well, why didn't it work? Can't guarantee you success. That's a lot of that is up to you, right? All I can do is give you a fighting chance. Well, you know what? If we had taken a short in the micros at 3.35, we'd get another $15 on the other side. So I'd have to say that this up move is pretty good. I think that the flows are getting a little complicated. So let me try. Here's my theory about what was going on here. I think that these first three waves here were short covering. This all happened well before anything was going on in the market. Some of this activity up here may have been related to President Lagarde. I don't know. But up here, there was some significant shorting in the 2-year and a bunch of other stuff. And you can see the cumulative delta coming down here, right? So there was an opposing meta order. And because we had moved up so quickly, they're going to cross back across that very easily, because there's not going to be very much liquidity behind them, right? But in the end, contrary to what I was believing, the buy meta order is still there. They're still closing out their position. I'm almost certain that this is short covering. So they could be short covering all day. In fact, they could be short covering all until the end of the week, and who knows? But it's next week when we get the trader positions and everything, is we're going to have to pay attention to how much of the shorts actually came off. But that kind of biases us towards continuing to take long in the treasuries, isn't it? Anyways, it's time for me to go to the day job. So I will see you guys tomorrow. Non-farms, right? It's going to be a big day. So I'll see you guys then. In the meantime, stay